Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Selective Insurance Group Inc. Annual Report. Selective Insurance Group Inc. provides a wide range of insurance products and services to various clients across the United States. The company operates through four main segments: standard commercial lines, standard personal lines, E and S lines, and investments. The company offers casualty insurance products that cover financial losses due to third-party bodily injury or property damage. It also provides property insurance products that protect against accidental loss of real or personal property. Additionally, Selective Insurance Group offers flood insurance products to its clients. In terms of investments, the company invests in fixed income securities, commercial mortgage loans, equity securities, short-term investments, and alternative investments. These investments are a key part of the company's business strategy, allowing it to generate revenue beyond just premiums. Selective Insurance Group serves a diverse range of clients, including businesses, nonprofit organizations, local government agencies, and individuals. The company partners with independent retail agents and wholesale general agents to offer its insurance products and services to these clients. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what might cause an insurance company's stock price to increase. The stock price of Selective Insurance Group Inc. has increased slightly in the past year due to several factors. One key reason is the company's strong financial performance. As a leading provider of property and casualty insurance, Selective Insurance has consistently delivered solid earnings and revenue growth, which has boosted investor confidence and driven up its stock price. Another factor contributing to the increase in stock price is the company's strategic initiatives aimed at improving operational efficiency and expanding its market share. By investing in technology and streamlining its operations, Selective Insurance has been able to reduce costs and enhance its competitiveness in a rapidly changing insurance landscape. Additionally, the company's commitment to providing excellent customer service and its focus on building strong relationships with policyholders have also contributed to its success. As a result, investors are increasingly recognizing the value of investing in companies that prioritize long-term sustainability over short-term gains. Overall, the combination of Selective Insurance's solid financial performance, strategic initiatives, and commitment to customer satisfaction has driven up its stock price in the past year. Selective Insurance Group, Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Selective Insurance Group, Inc. trades at a lower price-to-earnings ratio of 12 times and a lower price-to-book ratio of 1.57 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the growth side, standard commercial lines and E and S lines have been significant contributors, accounting for 71% and 11% of total revenues respectively. Strong investment income, improved underwriting performance, and active portfolio management have also played a crucial role in driving revenue growth. In addition, operating cash flow deployment and proceeds from senior notes have provided a boost to the company's revenue. Furthermore, increases in valuations in the public equities market and unrealized gains on equity securities have contributed to the growth in revenue. On the other hand, revenue decline has been driven by a decrease in the number of independent property/casualty insurance agents and brokers. Additionally, premium deficiency analysis has revealed lower than expected investment yields, which has impacted revenue. The net premiums earned and net investment income earned have shown significant increases, with growth rates of 9.4% and 16.3% respectively compared to the previous year. These factors highlight the importance of a diversified revenue stream and effective management of investments in driving revenue growth. Net income and profit margins experienced significant fluctuations between 2023, 2024, and 2025. In 2024, net income decreased by 43% to $207,012 due to an increase in loss and loss expense reserves. However, this trend reversed in 2025 with a 125% increase in net income to $466,411, largely attributed to rate increases taking effect. Profit margins also underwent changes during the same period. The combined ratio increased by 6% to 72.3% in 2024, but decreased by 5.8 points in 2025 compared to the previous year. Meanwhile, return on common equity, ROE, saw a decrease of 7.3% in 2024, but an increase of 7.4% in 2025. The reasons behind these changes are multifaceted. The decline in net income and profit margins in 2024 was partly due to increased competition from larger insurers, with lower operating costs and greater capacity to absorb risk. However, the improvement in 2025 can be attributed to favorable loss severities and lower than expected medical inflation. The company's financial performance indicates a significant improvement in its ability to generate cash from operations. The net cash provided by operating activities increased substantially to $1.2 billion in 2025, marking a notable milestone for the company. This increase is also reflected in the operating cash flows, which accounted for 25% of net profit after tax, NPW, in 2025. The consistent generation of positive operating cash flow over 3 years, from 2023 to 2025, further reinforces this trend. The data confirms that the company has successfully transitioned into a phase of generating substantial cash from its core operations. This achievement is a testament to the company's financial discipline and operational efficiency, setting it up for continued growth and success in the future. The company's debt level has undergone significant changes over the past year. According to various summaries, total debt increased from $6.09 billion in 2024 to $7.23 billion in 2025. This increase is attributed to the issuance of senior notes and an uptick in borrowings from FHLBI and FHLBNY. Additionally, long-term debt saw a substantial rise, increasing by plus 75% or $394,935. Interest expenses have also seen a notable increase, rising from $782,701 in 2024 to $877,843 in 2025. This represents a significant jump of over $95,000. Furthermore, interest expense increased from $28,878 in 2024 to $49,322 in 2025, indicating a substantial rise. The overall trend suggests that both debt level and interest expenses have changed significantly, with the company's financial obligations increasing substantially over the past year. The performance of various segments and regions in the insurance industry has been summarized. In terms of poor-performing segments, general liability, commercial automobile, workers' compensation, business owners' policies, commercial property, bonds, E&S casualty lines, and E&S property lines have shown underwhelming results. On the other hand, homeowners and personal automobile segments have performed neutrally, neither excelling nor struggling significantly. The Northeastern region has emerged as a well-performing area, accounting for 34% of net premium written, NPW, in 2025, with notable contributions from New Jersey, Pennsylvania, and New York. In the standard commercial lines segment, contractors have shown impressive performance, while mercantile and services and manufacturing and wholesale segments have underperformed. The standard personal lines segment does not provide specific information on performance metrics. Additionally, E&S lines and investments lack detailed performance data in the summary provided. The management of the company is optimistic about its future prospects, citing a strong financial position with a consolidated net worth of $3.8 billion as of December 31, 2025. The company's debt-to-capitalization ratio is below the maximum allowed under the line of credit, indicating a healthy balance sheet. Management has also entered into a new credit facility that provides a $100 million revolving credit facility with an option to increase to $200 million. The company's strategy for managing its tax obligations and pension plan liabilities is focused on prudent and reasonable planning strategies. The management aims to exceed the returns of the plan's policy benchmark by using a U.S. Treasury overlay derivative strategy. Additionally, the company has diversified its investments and does not have significant exposure to any single issuer. The alternative investments portfolio has a strong outlook, with net income increasing to $11.8 billion in 2025 from $17 billion in 2024. The company expects to achieve a return on equity (ROE) of 14.4% for the year, indicating a solid financial performance. Overall, management is confident about the company's ability to maintain its strong liquidity position and fund future dividends and interest payments. Management's focus on managing tax obligations, pension plan liabilities, and maintaining a healthy liquidity position suggests that they are committed to ensuring the long-term sustainability of the company. The company's diversified investment portfolio and strong outlook for alternative investments also indicate a solid financial foundation. The company's financial activities include several acquisitions and divestitures. In terms of acquisitions, the company has made notable purchases, such as buying shares from employees to satisfy tax withholding obligations. Additionally, the company has announced 2 share repurchase programs, one for $100 million in 2020 and another for up to $200 million in 2025. In regards to divestitures, there are a few instances mentioned. On page 68, it is noted that the company incurred losses on securities it intends to sell, totaling $1,445 in 2025 and $1,248 in 2024. Furthermore, the company reported a net realized loss of $-1,217 from disposing of fixed income securities. It's also worth noting that the company has mentioned potential divestitures through selling partnership positions on the secondary market. However, this is not a concrete instance, but rather a possibility for future transactions. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out to common stockholders, with notable examples including $1.57 per share in 2025 and a total payout of $182 million. Additionally, preferred stockholders have also received dividend payments, albeit at a lower rate. Furthermore, the company has also engaged in significant share buyback activities. In one notable instance, it purchased a staggering 1.093 trillion shares, demonstrating its commitment to returning value to shareholders through this means. This combination of dividend payments and share buybacks highlights the company's focus on shareholder value creation. Concerns about inventory buildup or supply chain disruption are mentioned in the report, but they do not directly relate to the company's operations. However, there is an indication of potential issues on page 169. The data suggests a significant increase in purchases and sales of short-term investments from 2024 to 2025. The numbers show a substantial jump in both purchases, -913,495 vs -516,183, and sales, 896,746 versus 471,650. This could be an indication of inventory buildup or supply chain disruption. While the report does not provide direct evidence of inventory buildup or supply chain disruption affecting the company's operations, the data on short-term investments suggests that there may be underlying issues. Further investigation is needed to determine the cause and impact of these changes. That concludes the financial summary for Selective Insurance Group Inc. Feel free to comment below, and I will be happy to answer them when possible.